Let's take a look at Raytheon Technologies. And in case you didn't know, Raytheon researches, develops, and manufactures advanced technology products in aerospace and defense. So they look into things like engines, missiles, defense systems, and they do a lot of work with the government too. So they've gotten pretty big government contracts over the years. Now we're going to try to figure out the intrinsic value of the company and how much the stock is worth based on an estimate of the future free cash flow. So let's see the market cap, 90.91 billion. Okay. And now the stock price, $60 even. So they have about 1.5 billion shares outstanding. So once we estimate the future free cash flow of the company, we have to discount that back to today's dollars. And then we have to divide that number by 1.5 billion. And that's how we'll come up with the estimated stock price of the company. And this is the best way to figure out the intrinsic value of a company. There are many, many ways to figure out the value of a company, but this is by far the best and used by top analysts and people like Warren Buffett. So let's look at their free cash flow. And this is the lifeblood of any business, because if you invest in a business, you want to see that they have excess cash left over after operating their business each year. And if they have a negative free cash flow, that means they have to find cash from somewhere else, which means more debt. And you don't want to operate your business with constantly getting more and more debt. It's like making $50,000 a year and then you spending $100,000 a year. You can't continue that lifestyle. It's going to catch up to you at some point when you run out of borrowing options. So you can see the free cash flow has been increasing quite a bit, which is a good sign. The net income is a little more stable, which is expected because free cash flow includes a lot of big one-time investments. So if this year they spent several $billion in some new materials or buildings, that comes out of free cash flow, but those amounts are depreciated on the income statement. So it's a lot smoother. It's not as lumpy as free cash flow. And revenue is usually the smoothest, and it's growing each year, so that's a good sign for an investor. Now we need to discount the future cash flows by the weighted average cost of capital. And in order to do that, we need to first figure out how much debt they have and interest they pay on that debt. So they have $1.8 billion of interest payments last year on their debt. And let's see how much debt they have on their balance sheet. So liabilities should list the current debt, which is debt due within the year. And you also want to look at current assets and current liabilities to make sure they could pay their current expenses. Because if they can't, that could be a big problem as well. So long-term debt is debt due beyond 1 year. So it could be due in 2, 5, 10 years. And the interest they pay on the debt is 4%, which seems a little higher than I expected, but not too bad. Income before tax, because now we have to get their tax rate so we could discount the debt payments. Because that interest payments are an expense, and that's a write-off, kind of like your mortgage interest. That's a write-off on your taxes. So now we see the effective tax rate of 28%. So even though they paid 4% interest on the debt, it actually cost them 2.93%. The higher your effective tax rate, the lower your debt. And now we need to figure out the cost of equity. So they have a really great beta. It's under 1, so it's very low volatility. And the cost of equity is 9%. So obviously, the cost of equity is a lot higher than the cost of debt, which is always how it is. The reason it's higher is you take a bigger risk. You don't receive that guaranteed interest payment each month or each quarter. Now we blend the debt and the equity, and we blend it based on the weight of the debt and equity, which is up here in the model, and the WACC is 7.1%. So we have to discount the future free cash flow by that 7.1%. And they have a healthy free cash flow, and it's all calculated from our inputs below. And if you have any questions, please leave it in the comments. We also calculated the terminal value, which is the future free cash flow after year 4 of all the years. And we discount these numbers back to today's dollars, and the intrinsic value of the company based off of their previous cash flows and income is $128 billion. And when you divide that by their shares outstanding of 1.5 billion, their stock price is $85. So that's the intrinsic value of the stock according to this model. And it's interesting to see that the stock was trading at intrinsic value for many years. It's around 85, maybe a little more. And then it looks like it had a big drop off. It looks like this might have been before coronavirus. Most companies have had a big drop around March. This seems like it had a big drop maybe January. It's hard to tell exactly with this chart what month that is. And it's trading at a discount now. So you might be asking, why is the stock now trading at a discount? Because all the top financial analysts, this is what they do for a living, equity analysts. They create models like this and they value the stock. And then they look at other things too, of course, like the future of the company and the industry. And then they give a buy or sell rating to the general public. So some people use that information as their indicators to buy or sell a stock. So now why is this stock selling at a discount? Because generally when something sells at a discount, it's because people don't think the future value of the company is going to keep at $85 a share. They think it's going to go down in the future to closer to $60 a share. So if you feel that way, then you may not buy the stock. But if you think $85 is appropriate and you think this is a good company with a good future and an industry that's likely to grow, you may buy the stock or invest more if you already own it. Now, let me know what you think in the comments. This is just one model, my model, and this is one opinion, and everybody has their own opinion on things, so I would like to hear yours. Thanks for watching.